Michael Saylor does have other assets in his personal life. He does have properties and things like that. And this particular vehicle obviously represents the vast majority of his net worth. Uh, but he'd still be okay. It's not like a financial kill shot. It's just a major setback. And so with Bitcoin, it is my largest individual asset, but it's one of many assets. And there's also a difference between someone who, say sticks half their net worth in Bitcoin versus someone who bought some Bitcoin and then because of superior performance, it's become half of their net worth.
This psychological difference can be a powerful factor in how an investor handles market downturns. Alden views Bitcoin as the fastest horse in the race, a quote she borrows from legendary investor Paul Tudor Jones, but she emphasizes that it's not the only horse.
I have a lot of Bitcoin exposure, but it's in that kind of broader mindset of more broadly that I want to own multiple types of high quality assets, short fiat currency where I can, or let other, let my assets do it for me on their balance sheets. And I think that, to quote Paul Tudor Jones, I think Bitcoin is the fastest horse in the race. But I don't think it's the only horse. And I think that I have a clearer head by not being 100% in on something. It gives me kind of a Zen aspect in bear markets. So for example, in November 2022, when Bitcoin had collapsed from 69,000 all the way down to like 16,000, I was at the Pacific Bitcoin conference. And we were having a good time. We were on stage, we were laughing. The energy there was high. And I think because one, people knew what they own, and two, anyone who wasn't levered or didn't size it inappropriately relative to their volatility and risk expectations, use it as a buying opportunity. So I think it makes sense for someone to be all in, but not necessarily everybody, and not even necessarily most people, is how I put it. Another way of kind of pointing out is that Michael Saylor does have other assets in his personal life. He does have properties and things like that. And this particular vehicle obviously represents the vast majority of his net worth. But he'd still be okay if Bitcoin had a problem. So I think people, you want to put yourself in a position where, if Bitcoin doesn't perform the way you think you will, it could be, obviously very damaging to someone financially, but it's not necessarily an irrecoverable thing. If they encounter an issue, and it's going to partially depend on their level of conviction and their level of research that they've done on it.
Yeah, agree.
So historically, it has mildly decreased cycle after cycle, and I think that's normal. I think that when you go from a $1 million asset to a $1 billion asset to a $1 trillion asset, it's naturally that the holding of it gets more diffused, and there's kind of less kind of tail optionality going on. So I think that over the next 5-10 years, I do expect volatility will decrease. And I view it as a good thing because as it kind of gets higher toward its total addressable market, we'd expect volatility to decrease. And also part of why people don't use it for payments at scale is that volatility. So you can't really price things in it because of that high volatility. We still live in a very fiat world. Our liabilities, either in debts or in just ongoing obligations, rent, mortgages, things like that. Our expenses are in fiat currencies around the world. So people can't really price things in Bitcoin. If Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease, and while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets to what we consider low, like gold. I think that there's a significant number of people that would spend more Bitcoin if they didn't have this administrative or tax overhead on top of it. That'll be jurisdiction by jurisdiction. So there's some countries that will be ahead of the game in terms of getting away from that, and other ones that'll be more reticent. It also generally should fuel innovation because right now our payment systems are very much permissioned payment systems. And we have software now. We have open source, decentralized, permissionless things to build on. And so tax can sometimes get in the way of that by basically saying that, this would be an easier way to do it, but because of tax, we can't. That's also, I think, part of what keeps stablecoins pretty attractive at the current time, not just the stability, but also because there's less of a tax overhead if you're just using it for holding and spending. But over time, I think that actually will be important. And for example, when people were kind of advocating the government to buy Bitcoin, I think a better policy is to let people use Bitcoin more easily. So I would actually be more interested in the politicians saying we want to, have a certain threshold for which Bitcoin transactions are not taxable versus telling me how much Bitcoin they want to buy on behalf of the government.
This leads to the topic of institutional adoption. Alden believes it's inevitable that Bitcoin will appear on a wide range of balance sheets, from corporations and pension funds to sovereign entities. It's simply not feasible for a multi-trillion-dollar asset to be owned solely by individuals.
I think there's no world where it gets to be a multi-trillion-dollar asset and only individuals own it and not other pools of capital. I think that basically once you get this big and liquid, it's inevitable that either corporate entities or pension funds or even some sovereigns are going to want to own it. Basically anything that you're responsible for managing, if you become bullish on Bitcoin, it makes sense for you to add it to your thing. So that starts at the yourself and your family, and then it trickles into professional life for those managing other types of assets. So I think it's totally inevitable that if it's going to be successful, it's going to be at all these different types of balance sheets. As far as concentration risk, I don't really view that as a problem because it's a proof of work network, not a proof of stake network. And the concentration is thus far pretty manageable. So MicroStrategy has 3% of coins, roughly speaking. Potentially the more bigger concern is that a lot of entities use Coinbase as custody. So I think they have something like 10% of coins, which is not fantastic, but I think not the end of the world. People have to kind of remember that even back in say 2011, like with Mt. Gox, at one point they had like a double-digit share of the network. So there's always been these little pockets of concentration that spin up and then either get diffused or break in some capacity. So I think that the network is sufficiently spread out that that's not really a long-term concern I have. And I generally view it as inevitable. There are people that say that Bitcoin has in some way failed now because these large entities hold it, but it's a permissionless asset. There's no way to prevent large pools of capital from owning it. And to the extent that the Bitcoin proponents that think it'll change the world, part of that involves going through every balance sheet out there, including increasingly big ones. It even goes back to in 2010 when the late Hal Finney was writing about this. He was kind of doing back of the envelope math on saying, Bitcoin has this many transaction throughput, and if this many people want to own it, they're going to have to own it through proxies. So he was kind of analyzing the concept of Bitcoin banks back then. So this has been kind of a known aspect from the beginning. And another one, Nick Szabo, he was one of the before Bitcoin came out, he was active in the field of kind of trying to create digital gold and other types of assets like this. And the way he envisioned it was a two-tier system where you have kind of a settlement network itself that's suitable for larger transactions, and then various mechanisms on top of that, whether it's software like Chalmy and Mints, or whether it's old school, just custody arrangements to allow smaller transactions and other things to scale. So I think that some degree of custody is inevitable, and some degree of connection between Bitcoin and everything else is inevitable, again, as long as it's successful. I mean, if it's not successful and it just kind of rolls over, then it doesn't get into balance sheets. But as long as it continues to be dominant at what it does, and as long as it continues to be decentralized and secure, I think it will show up on more and more types of balance sheets, and it's mostly a one-directional thing. I think until the past year, a big variable was it wasn't taxed well. So basically, for not tax, I mean accounting. Like it wasn't treated on accounting purposes very well. So basically, if it went down in price, they had to book that as a loss. But if it went up in price, they couldn't book that as a gain. So it just kind of ratcheted down. So they'd have to say, okay, here's our official financials, but here's like really what our financials look like, and that's not attractive to a lot of CEOs. In addition, because it's volatile, there's a lot of career risk where if you're already a CEO of a company, buying an asset that can go down 80% at certain times and has introduces risk where they might not otherwise want it. Historically, the way the company's been dealing with this whole fiat debasement issue is they decapitalize themselves. They pay out dividends, they buy back their own shares, they purposely take out debt they don't need just because they're basically shorting the fiat currency. Like an example I like to use is that, Coca-Cola has been profitable for like every year for like a century, and yet why do they have 40 billion or 50 billion in debt? And it's because they can. Basically, that if someone's going to offer them the ability to, issue bonds for 10 years, 20 years, 30 years at 2, 3, 4%, which until kind of recent high rates they were able to do, it's lower than their other cost of capital. They say, well, if we're going to borrow at 2% and buy back our own shares with it, they're arbitraging the fiat currency system just like everyone else. They're just doing it in a less volatile and explosive way as doing it with Bitcoin. And so that's been kind of the go-to choice for a lot of companies, whereas Bitcoin is one, until recently, it wasn't really big and liquid enough to be on their radar. Then the accounting issues were there. And once those things were addressed, like now that it's a $2 trillion network, now that the accounting issues are addressed, we do see it popping up more. But I still think it'll take years because of the high volatility aspect of it, which means that it's more disposed that someone who owns a lot of the company. For example, Michael Saylor had dominant voting rights in the company. So if you're able to convince one person to make a really decisive move, that's where that tends to show up. It's also, I think, not an accident that Fidelity was earlier into Bitcoin than most other financial institutions, because that's a more privately held entity. So if the CEO was on board with it, it could happen. Whereas if you have a more diffused ownership where the CEO might only own 2% of the company, and is basically just an employee there rather than like a true owner, you're less likely to get that kind of high conviction decision making compared to entities that have tighter ownership. That's also why you see a lot of small businesses, small private businesses will own Bitcoin. And you'll see a lot of people that are, they might be on the board of a pension, they might be on the board of a bank, and in their personal life, they might have a lot of Bitcoin because they can just make that decisive decision. But there's no one really in place at a lot of these types of entities that can just make a pretty decisive call like that if there's any degree of controversy to it, which there is because of the volatility and historically because of the accounting treatment. Over the long arc of time, I think it's worth monitoring. I've been able to talk to some of the experts that focus on this, so they kind of come up with their potential solutions and how they might address it. So just like how USB and Ethernet update over time, Bitcoin does update over time. In terms of non-consensus changes, there's regular updates. And then in terms of consensus changes, there's occasional updates that happen over time if a very large percentage of the network agrees to do it. And potentially they could replace the signature types with more quantum resistant signatures. The downside is they generally take a lot more space. And therefore you run into issues like the block size limit, the amount of bandwidth that is needed. So doing it prematurely is unlikely to be successful because there's going to be more pushback against the cost of that compared to doing it. So I think I'm optimistic that I know that there are solutions on the table. They might be just like how we talked before about the complexities of the fiscal budget, that there are solutions. They're just kind of hard to arrive at. The same is generally true for Bitcoin and quantum resistance, that if we do hit that point, there are solvable ways around it. And then, I still think it'll take many years to probably reach that point.
Regarding quantum computing, Alden acknowledges the threat but remains optimistic. She notes that experts are already working on solutions, such as implementing more quantum-resistant signatures.